make you think you're richer than you are, like kind of the opposite of that Scotiabank stuff, that you're richer than you think. A lot of times it's poorer than you think.
I can see the whole wide world with these two eyes, and I can be whoever I wanna be, 'cause it's my life.
Hi, thanks for joining us for another episode of Ask Spurrell CPA. Today as Edmonton Business Coach, we're talking about how you shouldn't increase your income in line with revenue. Again, as the Edmonton Business Coach, we're saying don't increase your income with revenue. And I have Michael here with me again. Michael, have you ever worked in any organizations that had any cash flow constraints and they had issues with people?
Actually, I did.
Yeah, you did? That was a tough situation, right? Mm-hmm. And sometimes the business owner, they just don't know any better. No one has taught them that, if you sell, another $1,000, you can't just take another $1,000 out of the company. So the quote that we have here today is a Warren Buffett quote, all-time great investor. And he says, accounting is the language of business. Accounting is the language of business. And the statistic that we have, 50% of all Canadian small businesses go out of business in the first 5 years. And 29% of these failed business owners will list running out of cash as one of the primary reasons for their failure, making running out of cash the second most common reason for business failure. And the story that we hear over and over again are business owners start thinking that if they need another $1,000 per month from their business, they can simply just sell another $1,000. So, Michael, what questions should those business owners be asking before they take out that $1,000?
Are most business owners used to seeing the cash flow in a business account?
Most business owners are not used to it. They start seeing all of this cash flow come in, and they've never seen deposits like that come into a bank account. When they compare it to their personal account, it seems like there's a whole bunch of money coming in because that's just the way a business operates. Because of a lot of expenses going out too.
Does the account activity often make them think they have money to spend?
Yeah, they start to they're working at a job. They never seen deposits more than $5,000 every payroll or something like that coming into their personal account, and all of a sudden now they're seeing deposits totaling $10,000, $20,000, $100,000 a month into their business bank account, and it makes them think that they have more money to spend, but in reality they don't have. They might not even have as much money to spend as they did when they were an employee, because they're not really truly considering the cost and the net income and how much of that is actually theirs to spend.
What are direct costs?
So the direct costs are the costs that are necessary to deliver the product and service, so they're directly tied with that product and service. So let's say you're a physician, you're running a medical clinic. The direct cost would normally be for every dollar that you bill the patient or you bill Alberta Healthcare. It would be the 70% that gets paid out to the contract physician. It doesn't, whenever you accrue that dollar, there's definitely, 70 cents going out. Or if you're doing construction, you bill the client $1,000, but it costs you $750 for the sub trades and the materials. And after you pay those direct costs of doing that job, the rest is the gross margin that's left over. So they're different than your overhead costs. Where your overhead costs, they tend to be, whether you do work or not, those overhead costs are relatively consistent. Where those direct costs, they'll vary directly with how much revenue or service you do. You do more revenue, the direct costs go up. That's not usually, when your costs go up, that's a bad thing. But if your direct costs go up because you doubled your revenue, that's not a bad thing. That just means you did more work, right? Whereas if you do less work, those costs will come down, but only because you did less work. So you had less contractors, less supplies to buy.
Do the direct costs often get paid after revenue is collected?
Yeah, so a lot of times you're looking at those deposits coming into the bank account and the revenue looks good. But really those direct costs, they're going to be paid after. They were bought on a credit card that's going to be paid out after, or they came from a supplier that gave you net 30 or net 60 days terms. Sometimes you'll end up seeing the money come in, make you it make you think you're richer than you are, like kind of the opposite of that Scotiabank stuff, that you're richer than you think. A lot of times it's poorer than you think when you're looking at a business bank account, because those deposits are big, but the expenses are going to be equally as big, and a lot of times those expenses, they'll come after the revenue's collected.
Why do you need to understand your gross margin?
So the gross margin is basically what's left over after you pay those direct costs. So starting to understand that gross margin in terms of a percentage. If I sell an additional $1,000 after I pay all the direct costs, I only have $250 left over. That can be, really powerful because that lets you understand that, I saw these, thousands or tens of thousands come into the account as deposits, but really at the end of the day, I only get to keep X percentage of those, or I don't even get to keep that. I only have this left over once I pay the direct costs, and then I have to, look at my overhead too as well, right? And tax implications.
Can business owners generally take money out of a business tax-free?
Yeah, so not only do you have to pay those direct costs, if you want to take that money for personal use, pay your personal mortgage, take a vacation, buy groceries, whatever you're doing, that's also going to, accumulate some personal tax. And there's going to be some tax implications as well. And those tax rates, in Alberta can be, anywhere from, on the corporate side, we're talking 11% if you keep it in the corporation, to as much as 48% if you take it out of the corporation at the highest marginal rate. In other places in Canada, it can be north of 50%. The tax rate, depending on what province or territory that you're in.
If there is a 50% tax rate, how much income is needed for $1,000 after tax?
Yeah, so if you had a 50% tax rate, which is terrible, and hopefully we can do better with good tax planning. But let's say if you do have a 50% tax rate, in order to get $1,000 out personally for your personal expenditures, we need to make $2,000. So if we make $2,000, we pay 50% of that as tax. $1,000, we have $1,000 left for our personal expenditures. So it wasn't just as simple as selling another $1,000. We needed at least $2,000 to overcome the tax.
If there is a 25% margin, how much revenue is needed for $2,000 in income?
Yeah, so we go back to that. Let's say we want that $1,000. We have 50% in tax, so we need $2,000 to get ourselves $1,000 on our personal end. So if you need $2,000 in income, and if you only have a 25% gross margin, you need to take that 2,000 and divide it by 0.25 or times it by 4. You need to sell $8,000 to get that $1,000 out. So again, you start at 8, you get to keep 25% of that, you get to keep 2, and then you pay 50% tax, you get to bring in 1. So it starts to put it into perspective. You're looking at these, say you have that $8,000 deposit in your bank, you don't have $8,000, you have $1,000 that you can take out. So, that's why you can't increase your personal income in line with revenue. You have to consider the gross margin and the tax rate that you're going to have to deal with.
Is this why business owners should think hard about personal expenses?
Yeah, they should think long and hard. You look at your personal budget and the difference between what you need to sell in your business if your personal budget is $6,000 a month as opposed to $5,000 a month could be really significant. Like in this example, that means you have to bring in an extra $8,000 a month in revenue in order to meet that extra $1,000 a month personally that you have. So whether that's fancy car payment or truck payment that you're thinking of, if you want that extra truck payment, it's a nice fancy truck and it's $1,000 a month and it's not a business expense, it's just a personal expense. You might need to sell $8,000 a month or more depending on what your tax rate is and what your margins are. So that cash can be really critical for a business, and those sales can be really difficult to achieve. So you got to take a long look, especially as an early phase or a startup entrepreneur, on is that really a necessary expense?
What are some ways that people should consider investing back into the business?
Yeah, so if we do have that revenue coming in, once we pay our gross margins, we have to decide if these aren't necessary personal expenditures, we want to say, how can we invest back into the business? So investing back into the business, it's generally a couple things that you're going to do. You're either going to buy equipment. So you're going to buy equipment that's going to make you more efficient and more profitable in the future, or allow you to get more projects, which are going to bring in more revenue. Or you're going to invest in people, and those people are going to make you more efficient and allow you to do more projects in the business. And a lot of people don't see that as that. A lot of people don't see the personnel of the business as, they see that as an expense, when really you can view people in your business as the same strategic initiative of adding equipment, because they're going to provide that same benefit after a while. And then the other one is marketing. And a lot of people really miss the boat on that. So when you're talking about investing back in your business, normally you're investing back in your business by getting equipment, or people that are going to allow you to be more productive, or marketing that's going to make the phone ring more often. And those are investments back in the business. Sometimes, people say investments back in the business, they're just investing back into a bad business model because they're losing money on their gross margin. They're not really investing in, new equipment and new people and more marketing, to really grow their business.
Will investing in the business make it easier to draw personal income in the future?
Yeah. So, you can really worry about, selling that first $8,000 so you can get your $1,000 out if those are the numbers. Or you can think about, hey, I potentially have $2,000 that I can invest back into the business and marketing. So I'm not worried about, do I have another $8,000? I have $8,000 in revenue, where I can think about, how do I generate $20 or $30 or $40 or $50,000 more a month in revenue. That's what's going to make it easier is strategic investments back into the business that'll pay back in perpetuity. So I think that's what we have here today. Thanks so much for tuning in. As always, please hit the like and subscribe button so we can continue to deliver you tips on how to beat the odds at business. And as always, please leave us some comments so we can respond back and know what you guys like addressed in future videos. Thanks very much.